Markets surge in relief as trade war fears ease, but is this just a temporary reprieve? Imagine waking up to headlines where global markets are bouncing back from the brink of chaos. It's a rollercoaster ride that keeps investors on the edge of their seats. On October 12, 2025, at 10:38 p.m. UTC, with an update at 12:57 a.m. UTC on October 13, U.S. equity index futures skyrocketed and oil prices recovered strongly, all thanks to a shift in President Donald Trump's tone toward China. This came after a period of intense market jitters caused by heightened trade tensions, where fears of a renewed US-China trade war had everyone worried. But here's where it gets controversial. Could this openness to a deal be a strategic pivot, or is it just rhetoric to calm the waters before more tariffs hit? Let's dive into the details and unpack what this means for everyday investors. To put this into perspective for beginners, equity index futures are essentially bets on how major stock market indexes, like the S&P 500, will perform before the actual market opens. They're a way for traders to hedge or speculate based on anticipated news. In this case, contracts tied to the S&P 500 and the Nasdaq 100 surged by more than 1%, signaling renewed optimism. This uplift followed Trump's earlier threats of imposing 100% tariffs on Chinese imports as retaliation against Beijing's export controls, a move that had previously unnerved global markets, as highlighted in reports about China's markets facing renewed threats from potential U.S. trade conflicts. And this is the part most people miss. Treasury futures, which reflect expectations for U.S. government bond yields, dipped during this rally, while oil prices climbed over 1%, showing how interconnected energy markets are with geopolitical shifts. Cryptocurrencies, which had experienced a massive sell-off the previous Friday amid record-breaking drops that left many wondering who the biggest losers were, began to stabilize. Precious metals, however, told a different story. Silver prices swung near all-time highs, fueled by a historic short squeeze in London's markets, where traders were caught off guard by rapid price movements due to trade-related volatility. And gold hit a new record peak, underscoring its role as a safe haven asset during uncertain times. For those new to trading, a short squeeze happens when investors who bet against a commodity, like silver, are forced to buy back in as prices rise unexpectedly, often amplifying the upward momentum. This event, combined with ongoing trade frictions, kept precious metals in the spotlight as investors sought security. Now, let's talk about the elephant in the room, Trump's approach to trade with China. On one hand, his willingness to negotiate a deal could pave the way for smoother global commerce and boost markets. But on the flip side, his history of threatening high tariffs raises questions about whether this is sustainable or just a ploy to gain leverage. Is this cooling of rhetoric a genuine step toward peace, or a setup for more aggressive actions down the line? Opinions are sharply divided. Some see it as diplomatic savvy, while others view it as economic brinkmanship that could hurt consumers through higher prices. What do you think? Do you believe Trump's shift signals a lasting thaw in US-China relations, or is it merely a pause before the next storm? Share your thoughts in the comments. Do you agree this could stabilize markets, or disagree that it's enough to prevent future volatility? We'd love to hear your take, as this debate is far from settled.